After the last video, a man in Tulsa named Raymond wrote me a letter on yellow legal paper. He asked one question. He wanted to know what that line was, the one I mentioned at the end about the 1916 law. He said his accountant told him I was wrong. His accountant told him the wealthy pay tax just like everybody else, only with better lawyers. Raymond, with all respect to your accountant, he is wrong. And the proof is sitting in a yellow document, signed on September 8, 1916, by President Woodrow Wilson at the Executive Mansion. That document is the Revenue Act of 1916, Public Law number 271 of the 64th Congress, and inside it, hidden in plain sight, is the line that built every great American fortune you can name. This is not legal advice. This is history. But by the time we are done today, you will see your tax bill differently for the rest of your life. Let me take you back to the spring of 1916. Europe is on fire. The war in France has been grinding for 2 years, and the United States is preparing slowly for the chance it might join. The federal government needs money, a lot of it. The Treasury is short, and the income tax, only 3 years old at that point, is not pulling enough revenue. So a Tennessee congressman named Cordell Hull, a quiet man with steel-rimmed glasses, who would later win the Nobel Peace Prize as Franklin Roosevelt's Secretary of State, walks into the House Ways and Means Committee with a package of tax increases. In mid-May of 1916, Hull delivers a bill that includes something the country has never had before in peacetime: a permanent federal tax on the estates of the dead. The rate would start at 1% on estates over $50,000 and climb to 10% on estates over $5 million. $50,000 in 1916 was real money. $5 million was a dynasty. Now here is the part the textbooks skip. While Cordell Hull was drafting that estate tax in committee rooms on Capitol Hill, the Rockefeller Foundation was already 3 years old. Its charter had been approved by New York Governor William Sulzer on May 14, 1913, with an initial endowment of $35 million from John D. Rockefeller Sr., supplemented in 1914 with another $65 million. The Carnegie Corporation of New York had been chartered in 1911, 5 years before the estate tax existed. Andrew Carnegie himself was still alive, walking the streets of Manhattan, watching Congress debate. And the lawyers who advised these men like Frederick Gates, John D. Rockefeller's principal advisor for over 40 years, were not asleep. They were watching every comma of Hull's draft. The Revenue Act of 1916 was signed into law on September 8th of that year. And when you read it, the very same act that created the federal estate tax, you find something extraordinary. Section 2 of the act, the section dealing with what was then called the income tax provisions, carried forward the charitable exemption that had been growing in American tax law since 1894. The estate tax in the original 1916 Act did not yet include a separate charitable deduction. That part would come 2 years later in the Revenue Act of 1918. But the architecture of the exemption, the legal scaffolding, was already standing. The foundations of Rockefeller and Carnegie sat there in plain sight, holding hundreds of millions of dollars. And the Internal Revenue Bureau, the predecessor to today's IRS, could not touch a penny of it. The estate tax aimed at the dead skipped right over the foundations of the living rich. not because of fraud, not because of a loophole anybody snuck in, because the law was written that way from the beginning, and almost nobody read it. I want to walk you through exactly how it works. Because once you see the structure, you cannot unsee it. The wealthy in America do not pay tax the same way you pay tax for one simple reason. They do not own things the way you own things. You own your house in your name. You own your retirement account in your name. Your paycheck arrives in your name, and your name pays the tax. The wealthy own through structures. And the most powerful of those structures is the charitable foundation, paired with two cousins called the charitable lead trust and the charitable remainder trust. In tax law, these are governed today by Section 501(c)(3) of the Internal Revenue Code, which grants the foundation itself tax-exempt status. Section 170, which lets the donor deduct the gift from his income tax in the year he makes it. Section 2055, which removes that same gift from his taxable estate when he dies. And Section 664, which is the section that creates the charitable remainder trust and the charitable lead trust, the two main split interest vehicles. I know those numbers sound like another language. Let me translate. 501(c)(3). That just means a nonprofit that the IRS has blessed as serving a charitable purpose. Once it has that blessing, it pays zero federal income tax on its investment earnings forever. Section 170. That is the income tax charitable deduction. If you give $100,000 to a qualifying foundation this year, you subtract that $100,000 from your taxable income on this year's return. If you are in the 37% federal bracket, the United States Treasury just paid $37,000 of your gift for you. Section 2055. That is the estate tax charitable deduction. The one Cordell Hull's law did not yet have in 1916, but Congress added in 1918 and has been refining ever since. Anything you leave to a qualifying charity at death comes off the top of your taxable estate before the IRS calculates the bill. Section 664, the split interest trusts, a charitable remainder trust, or CRT, is an irrevocable trust where you put in an asset, you take an income stream for yourself for a set number of years or for life, and whatever is left at the end goes to charity. A charitable lead trust, or CLT, runs the other way. The charity gets the income stream first, and at the end, whatever is left goes to your kids. That word irrevocable just means once it is done, it is done. You cannot pull the asset back out for yourself. That is the price the law makes you pay for the tax break. Now look at the contrast. You earn a wage. Your employer sends it through what is called a W-2. The federal government takes federal income tax. Then it takes Social Security, then Medicare, then your state takes its cut. Then the sales tax hits when you spend what is left. The effective rate on a working couple in this country sits somewhere between 24% and 35%, depending on the state, even before property tax. The Rockefeller Foundation in 1916, sitting on close to $100 million of endowment, paid zero, not a reduced rate. Zero. The same Revenue Act that invented the estate tax, signed the same year, exempted that foundation completely, and it still does today. The Rockefeller Foundation in 2024 reported assets of roughly $7 billion and paid zero federal income tax on its investment returns. Read that line again. $7 billion in assets, zero income tax. Here is the step-by-step the lawyers walk a client through. Step 1. The donor identifies an asset that has gone up a lot in value. A block of stock bought for $50,000 that is now worth $1 million is the classic example. If he sells it, he owes capital gains tax on $950,000 of profit. Step 2. Instead of selling, he gifts the stock to a charitable remainder trust under Section 664. The trust is now the owner. The trust sells the stock and pays no capital gains tax because the trust is exempt. Step 3. The donor takes a charitable deduction this year under Section 170 for the present value of what will eventually go to charity at the end of the trust. That deduction reduces his income tax bill this year, sometimes by hundreds of thousands. Step 4. The trust pays him an income stream for life or for a term of years. He still gets money out of the asset, just spread over time. Step 5. When he dies, whatever is left in the trust passes to charity. That portion is fully deducted from his estate under Section 2055. The IRS gets nothing on that piece. Step 6. The family controls the charity, the foundation, the donor-advised fund. The directors are family members. The grants go to causes the family chooses. The buildings get named after the family. The family name lives on through the giving. The Supreme Court has tested this structure many times. The most famous case is Bob Jones University versus United States, decided in 1983, where the court upheld the IRS revoking tax-exempt status from a school whose policies violated public policy. That case is mostly remembered for the revocation, but for our purposes today, it confirmed the framework. The exempt status is real. It is constitutional. It can be granted and revoked. It is the law of the land. Now the catch. Because there is always a catch, the foundation has to actually serve a charitable purpose. Under Section 4942 of the Internal Revenue Code, private foundations must distribute at least 5% of their net investment assets every single year. If you have $100 million in the foundation, you have to give away $5 million a year, every year. If you do not, you owe an excise tax. The foundation has to file an IRS Form 990-PF every year, which is a public document anyone can read. The Split Interest Trust file IRS Form 5227. The compliance is real. The lawyers and accountants are real. The legal fees are real. This is not magic. This is engineering. And the wealthy hire the engineers. Now let me bring you back to that May Day in 1913 in New York City. The Rockefeller Foundation charter was approved by Governor Sulzer on the 14th of that month. On May 22nd, just 8 days later, the trustees held their first meeting. John D. Rockefeller Jr., the son, became the first president and chairman. Jerome D. Green took the secretary's chair. Louis Garneau Myers became treasurer. The board had 9 men. One of them was Frederick Taylor Gates. Frederick Gates is a name almost nobody outside of tax history remembers, and he should be a household name. Gates was a Baptist minister from Maine who became John D. Rockefeller Sr.'s principal philanthropic advisor in 1891 and stayed in that role until 1923. He is the man who told Rockefeller, somewhere in those early years, that giving away money the right way was harder than making it. Gates engineered the structure of the foundation. He sat at the table when the charter was drafted. He worked with attorneys who understood that if you locked up wealth inside a charitable corporation chartered by the state, future tax laws would have to respect that corporation as a separate person under the law. And that is exactly what happened. When the Revenue Act of 1916 came down 3 years later, with Cordell Hull's estate tax rates climbing toward 10% on the largest fortunes, the Rockefeller endowment of $100 million sat in a separate legal entity, untouchable. The estate tax could only reach assets Rockefeller still personally owned at death. Anything already gifted to the foundation, by definition, was no longer his estate, and the foundation itself, as a 501c3 charitable corporation, paid zero on its investment income. The same story plays out with Andrew Carnegie. The Carnegie Corporation of New York was chartered in 1911 with $125 million, the largest single act of philanthropy in American history up to that point. The Carnegie Endowment for International Peace had been founded in 1910. The Carnegie Institution for Science in 1902. By 1916, when Hull's estate tax passed, Andrew Carnegie had given away the bulk of his fortune into structures that were already legally separated from him. When he died in 1919, the estate tax that nominally applied to his death barely scratched what he had built. Today, more than a century later, the Rockefeller Foundation still operates from offices on West 49th Street in Manhattan, with assets that have grown to roughly $7 billion, depending on the market. The board still includes a Rockefeller. The decisions about where billions of dollars get directed are still effectively guided by the family that put the money in. They do not need to legally own it anymore. They direct it. And the Internal Revenue Service, the same agency that audits your mileage log, never sends them a tax bill on that endowment. By design. By the law of September 8th, 1916, and every refinement since. I want you to picture for a moment what that means at the kitchen table. A man in Cleveland in 1965, retired from the steel mill, sits down to pay his federal taxes. He earned $6,000 that year. He owes a little over $1,000 to the federal government. Then he owes Social Security tax on top of that. Then he owes Ohio income tax. Then property tax on his small house in Parma. By the time he is done, almost a quarter of what he earned that year has gone to one government or another. Same year, the Rockefeller Foundation's investment income paid zero federal income tax. Not because anyone broke the law, because the law, written when the steel mill worker's father was a boy, made it that way. You pay income tax on every dollar you earn. You pay payroll tax on every paycheck. You pay sales tax when you buy groceries. You pay property tax on the house you live in. If you accumulate enough to leave behind, your kids pay estate tax. The wealthy run their money through a charitable foundation that pays zero on all of it. And here is the moment I want to hold in front of you. They are not breaking the law. The law was written this way from the beginning. The same legislator who created the estate tax in 1916, Cordell Hull, was a careful and decent man. He was not part of any conspiracy. The exemption was already in American tax tradition before he wrote his bill. But the people who could afford lawyers in 1916 read the law. The people who could not, did not. And the gap between those two groups has been compounding for 110 years. Recognition is the first step. Not anger, recognition. Because once you see the structure, you can ask whether any piece of it is available to you. And the answer, in some forms, is yes. I am not your attorney and I am not your CPA. Anything I say here is general history and education. You need a licensed professional in your state before you do anything. With that said, here is the landscape. At the bottom of the ladder, available to almost anyone, is the Donor Advised Fund, or DAF. A Donor Advised Fund is a charitable account at a sponsoring organization like Fidelity Charitable, Vanguard Charitable, or Schwab Charitable. You put money in. You take the income tax deduction this year under Section 170. Then over the years that follow, you direct grants from the account to qualifying charities of your choice. Fidelity opens a donor advised fund with no minimum these days, though most people start with $5,000. Vanguard requires $25,000 to start. Schwab requires $5,000. The deduction is real. The control over grants is real. The cost is low. A step up from there is the Charitable Remainder Trust, the Section 664 vehicle I described earlier. Most attorneys will tell you it makes sense at around $250,000 of contributed assets and up, because the legal fees to draft and administer the trust run several $1,000s a year. Below that threshold, the math stops working. A step above that is the private foundation. To make a private foundation function with real grant-making and proper governance, most practitioners suggest a minimum of $500,000 to $1 million in starting assets. The foundation has to file Form 990-PF every year, comply with the 5% payout rule under Section 4942, and operate at arm's length from the donor on 100 small details that the IRS watches carefully. What the wealthy are using is mostly the third tier, sometimes wrapped together with the second. What you and I have available, realistically, is the first tier, the Donor Advised Fund. It is a fraction of what Rockefeller built. But it is the same legal family, the same Section 170 deduction, the same general structure of giving today while controlling the direction of the gift over time. Have the conversation with an estate planning attorney in your state. Ask specifically about donor advised funds and about whether a charitable remainder trust makes sense for you. Bring your tax returns. Bring a list of any appreciated assets you own. Pay the consultation fee. It is worth it. So here is where we land after this long walk through history. The line I mentioned at the end of the last video, the line Raymond from Tulsa wrote me about, is in Section 2 of the Revenue Act of 1916 and the charitable architecture that grew out of it through 1918, 1921, 1969, and every reform since. The wealthy in this country have never paid tax the way you do. They have not been cheating. They have been using the law as written, the same law you and I live under. But with the lawyers and the lead time and the structures already in place by the time the rates went up. If you got something out of this, the most important thing is the recognition. The second most important thing is a conversation with a competent professional. Not because you are going to build a foundation tomorrow, Because once you understand the language, you can ask the right questions, and you can stop being one of the people who never read the law. Next time, I want to take you inside the 1969 Tax Reform Act. That is the year Congress looked at exactly what the foundations had become and tried to put a leash on them. They wrote the rules that govern private foundations today. The 5% payout, the self-dealing prohibitions, the excise tax on investment income. They wrote those rules in response to families like the ones we talked about today. And there's a story there that almost nobody tells about who fought the reform and who quietly let it pass. Until then, take care of yourself, take care of the people at your table, and read the laws that govern your money. Nobody else is going to read them for you.